Duolingo stock just gave investors a strange setup. The business is still growing fast. Earnings beat expectations, cash flow looks strong, and the balance sheet has over $1 billion of cash with no debt. But the stock still dropped hard because guidance did not match the growth stock expectations. So today we are asking one simple question. Is Duolingo now a high quality growth stock at a reset price, or did the guidance warning expose a real problem? This is not financial advice. I'm walking through the business, the latest numbers, valuation, the bull case, the bear case, and what I would watch next so you can decide whether Duolingo belongs on your own research list. If you would like stock breakdowns that separate strong companies from stocks that are still too risky, subscribe to FinanceToGo. I'm building a research list using numbers, valuation, and plain English stock analysis, not hype. So, why do investors care? Duolingo is not just a language app anymore. It is a consumer subscription software company built around daily habits, gamification, and a brand that a lot of people genuinely like. That matters because the best consumer apps can scale with very little physical infrastructure, and once users build a habit, the business can become very profitable. The category is attractive, but it is not risk-free. AI can help Duolingo create content faster and make speaking practice better. But AI can also create new competitors. That is the tension in this stock. Duolingo may be one of the winners from AI in education, but it still has to prove the cost and competition side does not hurt the economics. So, the quarter itself looked strong on the headline numbers. Revenue was $292 million, up 26.5% year over year, and slightly ahead of expectations. GAAP EPS was 0.89 versus about 0.75 expected. Adjusted EBITDA was $83.4 million, which was a 28.6% margin. Free cash flow margin was 50.6%. Those are not bad numbers. The problem was the forward-looking piece. Q2 and full-year bookings guidance missed expectations. And for a growth stock, bookings are a major signal. The market was not saying Duolingo suddenly became a bad business. It was saying the stock price had been expecting a cleaner growth path than management was guiding to. So the simple read is this. The past quarter beat, but the next few quarters have to prove that growth is still doable. My FinanceToGo score is 7.2 out of 10. Growth scores high because revenue and daily active users are still moving in the right direction. Cash flow and balance sheet also score well because the company is producing cash and has no debt. The score is not higher because valuation and guidance risk still matter. A high-quality company can still be a poor stock if investors pay too much or if growth expectations reset lower. That is why I would put Duolingo in the quality but wait bucket rather than treating the sell-off as an automatic buy signal. Let's take a look at the valuation. At around $108, Duolingo sits inside my rough fair value range of $105 to $135. The buy zone is cleaner below roughly $95 to $100 because that gives more room for guidance risk and margin uncertainty. The valuation is a blend of sales, free cash flow, and scenarios. Management commentary points to over $350 million of free cash flow for 2026, which is a real anchor. But because this is still a growth stock, the fair value range moves quickly if bookings slow or if AI costs pressure gross margin more than expected. So this is not a cheap at any price, it is more like interesting after the reset, but I want proof that the reset is over. Let's take a look at the bull case. So, the bull case starts with the product. Duolingo has a strong brand. strong habit formation, and global reach. That is very hard to build. The app has become part of daily life for a lot of users, and that kind of engagement can support a durable subscription business. The second pillar is the model. This is an asset-light subscription company with revenue still growing more than 25%. Daily active users still growing, and free cash flow that already looks very strong. That combination matters because Duolingo is not just spending for growth with no proof of economics. The business is already showing it can turn engagement into cash. The third pillar is AI. We already talked about AI as a risk, but on the bull side, it can also make Duolingo better. If AI helps the company create lessons faster, improve speaking practice, personalize learning, and widen the product gap, then the current sell-off may end up looking too pessimistic. So the compressed bull thesis is this. It's a loved product, sticky habit, global subscription model, clean balance sheet, strong cash flow, and AI upside. If bookings recover and margins hold up, Duolingo can still look like a high-quality growth stock that the market temporarily punished too hard. But there's always a bear case to it as well. The bear case starts with guidance. The latest quarter beat on revenue, EPS, and cash flow, but the forward-looking bookings guidance missed expectations. For a growth stock, that matters because the valuation depends on the next few years, not just the quarter that already happened. The second risk is valuation. Even after the reset, Duolingo is not a deep value stock where the market expects nothing. Investors are still paying for strong growth, strong engagement, and long-term margin expansion. If growth normalizes faster than expected, the multiple can compress even if the company remains high quality. The third risk is AI costs and competition. AI can make Duolingo better, but it can also make language learning alternatives easier to build. And if AI features increase usage costs, margin progress could slow. That does not break the thesis by itself, but it does mean the company has to prove AI as a net advantage, not just a bigger expense line. So the compressed bear thesis is this. The bookings may be slowing and valuation still demands execution. AI could pressure margins and competition could get tougher. For me, the thesis weakens if bookings disappoint again. Daily active user growth slows, gross margin keeps trending lower, or free cash flow stops supporting the story. Let's come to my final verdict. My verdict on Duolingo is watchlist. Quality growth at a reset price. The company is strong. The product is loved, the balance sheet is clean, cash flow is impressive, but the stock still needs guidance and margins to prove the reset is an opportunity and not a warning. The pattern lesson here is useful for other growth stocks too. A company can beat the quarter and still sell off if the forward-looking numbers disappoint. For Duolingo, the next scoreboard is bookings growth, daily active user growth, gross margin, adjusted EBITDA margin, and free cash flow. If you want more stock breakdowns like this, subscribe to FinanceToGo and tell me in the comments, is Duolingo a high quality growth stock after reset, or is the bookings guidance a real warning sign? Again, this is educational content only and not financial advice. Do your own research and make sure any stock fits your own risk tolerance and time horizon.